You have probably spent hours obsessing over interest rates, researching RBA decisions, comparing lenders, hoping rates drop by another 0.25%. But here's the truth. None of that matters if you don't understand three specific numbers that banks use right now to decide whether they'll even let you buy a property. In fact, I'm going to show you a situation where a rate cut of 1% doesn't change a thing because one of these numbers blocks you entirely. And if you're seriously buying property in 2026, you need to understand this before you waste another minute on rate predictions. So let's go. By the end of this video, you're going to know exactly which number will make or break your property deal. And here's a spoiler. It's probably not the one keeping you awake at night. I'm going to show you a real scenario where someone earns good money, finds an amazing property, rates are at the lowest in years, but they still get declined by the bank. And the reason has nothing to do with interest rates. So stick around because this changes everything. Let me start with the confession. I used to be one of you. I'd wake up, check the RBA decision like it was the weather, calculate how a 0.25 point would save me $50 a month on repayments, spend entire weekends comparing which banks had the lowest rates by 0.15%. I thought interest rates were the number that mattered. Then I applied for a property loan, and that's when everything changed. I had good income, I'd saved a deposit, I'd done my homework on rates, fixed versus variable, the whole lot. But when I sat down with the bank, something unexpected happened. The loan officer didn't spend much time talking about rates at all. Instead, he pulled out a spreadsheet and started asking about my existing debts, my car loan, credit card balance, even my HEX debt. He asked about my income, calculated some ratios I didn't understand, and then said, actually, we can't lend you as much as you thought, even though you technically qualify at the current rate. I was confused. Rates were the lowest they'd been in a decade, but none of that mattered. What mattered were three numbers that I and most Australian property buyers have never heard of. Three numbers that banks use every single day to decide who gets approved and who gets declined. Three numbers that, frankly, have way more power over your property journey than the RBA's cash rate ever will. And if you're buying property in 2026 or planning to in the next few years, you need to understand these three numbers right now because the lending environment is changing. New regulations just came into effect. And if you don't know what these numbers are, you could be spending months preparing to buy only to get declined when you think you're ready. So let me introduce them. The first is something called your debt to income ratio, or DTI. Here's how it works. You take the total debt, so everything you own, including mortgages, car loans, credit cards, personal loans, even HEX help, and divide it by your annual gross income. That's your DTI. Let me give you an example. Let's say you earn $100,000 per year. You've got a car loan with $30,000 left to pay. You've got a credit card of $8,000 and you've got a HEX debt of $15,000. That's $53,000 in total existing debt. Your DTI is $53,000 divided by 100,000, which is 0.53 times your income, or as the bank says it, a DTI of 0.53x. Now, this seems like a healthy number, right? You're only 0.53 times your income in debt. But here's where it gets interesting. You want to buy property, you need to borrow $450,000. So your total debt is $503,000 and your income is still $100,000. Your new DTI is 5.03x. That's still below the magic number that banks typically use as a benchmark, which is 6 times income. So on paper, you should qualify. But here's the problem, and this is critical. And it just got much worse in 2026. From February 1st of this year, 2026, the Australian banking regulator called APRA put a new rule in place. Banks can now lend to people with high DTI. That's anything at 6 times income or more, but only for a maximum of 20% of their new lending. For investors, it's capped separately, but the principle is the same. So what does this mean in real terms? It means if your bank is a big lender and have already issued 20% of their new loans to high DTI borrowers, you could be perfectly qualified for a DTI of 5.5x, but you still get declined because they've hit the cap. You could have the income, you could pass the serviceability test, rates could be rock bottom. But if your DTI is high and your bank has already hit the 20% ceiling, they simply can't lend to you. It's not a judgment call, it's not discretionary, It's a regulatory wall. Think about that for a second. The first number, DTI, can block you entirely, regardless of what's happening with interest rates. And it gets worse. Different banks have different internal limits on DTI. Let me show you. So Commonwealth Bank will manually review anything above 7 times income. National Australia Bank, or NAB, hard cap at 9 times income. ANZ also has a hard cap at 9 times income. Westpac will manually review anything above 7 times your income. So depending on which bank you go to, your DTI might be acceptable at one bank, but rejected at another. And as a property buyer, that's not something you can negotiate away. You can't haggle on your DTI. You can't refinance it. It's a hard mathematical constraint. Now, what's considered a good DTI? Anything under 3.6x is excellent. Lenders absolutely love this. You'll get the best rates and the easiest approval. Between 3.5 to 5x, it's pretty good. You'll qualify probably at reasonable rates. 5x to 6x is acceptable, but you are getting tight. So you're in the zone where lenders will scrutinize your application more carefully. And anything above 6x, you're high risk. You're in that 20% cap zone. Getting harder to find a lender. Here's the practical impact. If you're carrying existing debts, credit cards, car loans, personal loans, HEX help, that existing debt is directly limiting how much house you can borrow for. It's a hidden ceiling on your borrowing power. That's why some of the smartest property buyers I know do this before they even start looking at a house. They aggressively pay down their consumer debt, not because they're financially conservative, but because they understand that cutting their DTI by half might unlock an extra $100,000 in borrowing capacity. And that's more valuable than waiting 12 months for rates to maybe drop by 0.25%. Okay, so that's DTI. That's the first number, the one that can block you entirely. But there's a second number that's equally dangerous, and even fewer people understand it. The second number is called your loan to value ratio. This one's a bit different from DTI. It's not about your total debt across life. It's specifically about this property you're trying to buy. So here's how it works. You take the loan you need and you divide it by the bank's valuation of the property. Not the purchase price, but the bank's valuation. And that gives you your LVR as a percentage. Let me show you with an example. So you find a property you absolutely love. The asking price is $600,000. You're going to put down a $100,000 deposit. So you need to borrow $500,000. So simple maths, $500,000 divided by $600,000 equals 83%. So your LVR is 83%. Now, why does this matter? Banks have a magic number for LVR, and it's 80%. Anything below 80% LVR, you're in the safe zone. Bank considers you low risk. You get standard interest rates. You don't need lender's mortgage insurance. But anything above 80%, you've crossed into what banks call higher risk territory. And suddenly things change. First, you need to pay lender's mortgage insurance, or LMI. This is an insurance policy that protects the bank, not you. And it's expensive. So on a $500,000 loan with an 85% LVR, you're looking at an LMI cost of $15,000 to $20,000, sometimes more. Second, your interest rate goes up. You don't get the best rate the bank advertises. You get a higher rate because you're higher risk. And third, your serviceability assessment becomes stricter. We'll talk more about that in a second. But basically, if you're above 80% LVR, the bank is more conservative when it comes to stress testing whether you can actually afford the repayments. So the difference between 78% LVR and 82% LVR is not just a 4-point difference. It's the difference between getting approved easily versus having to jump through extra hoops, pay an extra $15,000 to $20,000 in insurance, and accept a higher interest rate. But here's the thing that caught me off guard when I first learned about this. The LVR is calculated on the bank's valuation, not the purchase price. So let me show you how this creates a real problem. So you find a property at auction. The market is hot. There's strong bidding. You win the auction at $650,000. You put down a $50,000 deposit and you need to borrow $600,000. So quick maths, 600,000 divided by 650 equals 92% LVR. So that's pretty high, but that's okay. But then after you've won the auction, after you've committed to the purchase, the bank sends out a valuer. The valuer comes back and says, look, I reckon the property's worth 610, not 650. Now, all of a sudden, your LVR becomes 600 divided by 610. That's 98% LVR. Now, you're way above 80%. You need LMI. Your rate goes up. Your serviceability gets stricter. And you might even fail the serviceability test because your repayments have gone up due to the high rate and the LMI costs. You've already committed. You've already won the auction. You're already emotionally invested. And the bank's essentially saying, we'll lend you the money, but on worse terms than you thought, because our valuation is lower than the purchase price. This is a real thing that happens. And it's devastating because by the time you discover it, you've usually already put in your best offer. So here's the strategic insight. Never assume the bank will value the property at the purchase price. Banks are conservative. They look at comparables. They look at condition. They look at location. And sometimes, especially in hot markets where you've bid aggressively, the bank's valuation comes in lower than what you paid. That's why smart buyers, and this is crucial, smart buyers ask the bank for a pre-contract valuation before they make an offer. They find out upfront what the bank will value the property at. That way, they can calculate the actual LVR before they're emotionally and financially committed. If the valuation is lower than expected, you've got time to renegotiate or walk away or adjust your offer. You don't find out after the auction that you're suddenly at 95% LVR and facing an extra $20,000 in costs that you didn't budget for. So that's number 2, LVR. It determines whether you need LMI, what interest rate you pay, and how strict your serviceability test will be. And now we get to number 3. And honestly, this is the one that's hitting Australian property buyers the hardest right now in 2026. And it's called your mortgage serviceability ratio. That's the percentage of your gross monthly income that goes toward mortgage repayments. The industry benchmark is 30%. That's what you see everywhere. You shouldn't spend more than 30% of your income on a mortgage. But here's the reality that no one's talking about. Hardly anyone qualifies on a 30% anymore. The most recent data I have shows that in Sydney, new mortgage buyers need 62% of their income to service a loan on the median property. Adelaide, 51.8%, Brisbane, 48.3%, and Melbourne, 44.8%. Even in the most affordable major city, Melbourne, new buyers are spending 44.8% of their income on mortgage repayments. That's nearly 50%. That's not sustainable. That's financial stress. That's living paycheck to paycheck with no buffer. So how are people actually getting approved when the numbers are this bad? Well, there are a few things that's happening. First is the first home buyer schemes like the expanded first home guarantee reduce deposit requirements. 2, some buyers have guarantors, usually parents who help. And 3, some are accepting high LVR and paying LMI just to get into the market. But here's the kicker. This is really important, right? Banks don't lend based on the 30% benchmark anymore. They lend based on a stress test. So APRA, the banking regulator, requires banks to assess your serviceability not at your actual interest rate, but at your actual rate plus a 3% buffer. So if you're borrowing at 5.34%, which is roughly the current rate, the bank assesses whether you can afford repayments at 8.34%. That's a huge difference. At 5.34%, your repayments on a $500,000 loan is around $2,700 per month. At 8.34%, they're about $3,650 per month. That's nearly $1,000 more per month the bank assumes you'll need to be able to handle. So even if your actual serviceability ratio, the amount you pay now, is 32% of income, the bank is stress testing you at 45% of income. And if you can't handle the stress test, you don't get approved. This is why interest rates, but not in the way everyone thinks. A 0.5% rate cut doesn't directly change the serviceability ratio that much at all. Your repayments might drop $150 a month on a $500,000 loan. But what it does do is make the stress tests less harsh. If rates drop from 5.34% to 4.84%, the stress test becomes 7.84% instead of the 8.34%. And suddenly that $150 a month might become meaningful in the approval decision. But here's what blows people's minds. A 1% increase in your actual income does more for your serviceability ratio than a 0.5% rate cut. Let me show you why. So say you earn $80,000 per year and you need to borrow $500,000 at 5.34%. Your monthly repayment is $2,700. Your actual serviceability ratio is 40.5% of your income. And the bank wants it under 30%, so you don't qualify. But if you manage to increase your income to $90,000 per year, same loan, same rate, same repayment, your serviceability drops to below 36%, and suddenly you're much closer to qualifying. raise your income by another $10,000 to $100,000 per year, and your serviceability is now 32.4%. And now you qualify. A $20,000 income increase took you from decline to approved. A 0.5% rate cut, it would have only saved you about $150 per month, which is $1,800 a year. That doesn't move the needle on serviceability. So here's the contrarian insight. If you're struggling to qualify on the property you want, fixing your serviceability ratio by earning more is more powerful than waiting for interest rates to fall. Now, there's one more thing about serviceability that's important. The banks don't just look at your mortgage repayments. They look at your total debt servicing costs, including your car loan, credit cards, personal loans, everything. So if you've got a $300 car payment and $200 credit card minimum, and your mortgage repayment is $2,700, the bank might assess your total debt servicing ratio as 300 plus 200 plus the 2,700 divided by your monthly income. And that brings us full circle back to the one number at the very start, DTI. These three numbers are interconnected. A high DTI constrains your borrowing capacity. A high LVR affects your interest rate and serviceability test. And a bad serviceability ratio means you don't meet the bank's criteria for approval. They're not separate issues. They're all part of the same puzzle. Now, let me walk you through a realistic scenario. This is a situation I've seen happen to people, and I want to show you how all three numbers collide. So I had a client, let's call her Sarah. It's not her real name. She's a 32-year-old marketing manager in Brisbane. She earns $95,000 a year. She saved $80,000 for a deposit. She's been pre-approved by a bank, and rates are starting to come down. Everything looks great, but she hasn't thought about these three numbers. Here's her situation. Her existing debt is she's got a car loan of $35,000. She had HEX debt of $22,000, a credit card limit of $8,000, giving her a total existing debt of $65,000, and her income, $95,000 per year. So her DTI right now is that 65 divided by 95K, which is 0.68x, which is very healthy. Now, Sarah wants to buy a house in Brisbane CBD. Median price right now is $650,000. She got her $80,000 deposit, so she needs to borrow $570,000. Her new DTI is 65 plus the $570,000 divided by 95,000. That's 6.68x. That's above the 6x benchmark. She's now in high DTI category. From February 1st, 2026, her bank can only do this if they've got capacity in their 20% high DTI allocation. And let's say they do. They approve her. But now let's talk about number two, which is LVR. So Sarah's LVR, with a loan at $570,000, the bank valuation after inspection is $630,000, which is lower than the purchase price. So the LVR of 570 divided by the 630 is 90.5%. That's way above the 80% benchmark. So she needs to pay LMI. And that costs her about $18,000, which gets added to her new loan. So now she's actually borrowing $588,000, not $570,000. And her new LVR with the additional cost is 93.3%. Now let's look at number three, which is serviceability. Sarah's monthly income of $95,000 divided by 12 is $7,917 per month gross. Her mortgage repayments at 5.5% over the 30 years is $3,332 per month. But the bank stress tests it at 8.5%. So the same loan at 8.5% is $4,393 per month. So Sarah's total debt servicing, so her car repayment at $630 per month, HEX debt, card minimum payment of $200, mortgage repayments of $4,393, brings her total monthly debt payment to $5,223 per month. So her serviceability ratio right now is at 65.9% of income. The bank's maximum threshold, which is usually 30%, sometimes up to 40% in competitive situations. So in this situation, Sarah doesn't qualify and she's been declined. And here's the brutal part. None of this is about interest rates. Rates could drop to 4% tomorrow, and Sarah's approval situation wouldn't meaningfully change. Why? Because her DTI is already high. She's taking up a slot in the bank's 20% high DTI allocation. Her LVR is high. She's paying LMI and getting a premium interest rate. her serviceability ratio is completely blown out. Even at lower rates, she's still spending too much of her income. The only thing that would fix Sarah's situation are she pays down her car loan and credit card aggressively to reduce her DTI, saves for a bigger deposit to reduce her overall LVR, and increase her income, which improves the serviceability ratio. Or she also looks for a cheaper property, right? Because a lower loan amount equals better ratios across the board. Those are the real levers, not waiting for a rate cut. Here's why I'm telling you this in January 2026, because the lending landscape has just shifted. On February 1st this year, APRA implemented new DTI rules. And what this means is banks can no longer be as relaxed about high DTI lending. Before, a high DTI was a concern, but not a hard stop. Now it's capped. And that means banks will be more scrutinizing of high DTI applications. High DTI investors especially will face tighter lending. The bar for approval just got higher, even with good income and a solid deposit. And you can't out-earn a bad DTI anymore. Here's the implication. If you're sitting on significant existing debt, car loan, credit cards, personal loans, and you're planning to buy a property in 2026, your window of opportunity is narrowing. The longer you wait, the more likely the bank will want you to hit their 20% high DTI cap. That's why right now, in early 2026, the smartest buyers are doing these few things, right? Firstly, aggressively paying down consumer debt to improve their DTI. Second, saving large deposits to improve their LVI and reduce LMI. Third, increasing their income or demonstrating additional income to improve their serviceability ratio. And fourth, getting pre-approved and locking in early before lenders hit capacity. Because once the market gets competitive again, and it will, these things become way harder to change quickly. Now, I want to address the elephant in the room. If all this is true, if these three numbers matter more than interest rates, then why do we spend so much time talking about interest rates? Honestly, because interest rates are easy to talk about. They're in the news. They're the headline numbers. Everyone can understand rates went down from 4 to 5%. But DTI, LVR, and serviceability, those are more complex. They require calculations. They require understanding your specific situation. They're not sexy news stories. But here's the thing. For your personal property decision, they're infinitely more important. A 0.25% interest rate cut saves you about $60 per month on a $500 loan. That's nice, but it doesn't move the needle on whether you actually qualify. A DTI reduction of 0.5 times achieved by paying off a $50,000 car loan and a credit card debt might actually unlock $100,000 in additional borrowing capacity. That changes your borrowing power by a factor of 10. So here's what I want you to do. Stop obsessing over interest rate predictions. Stop watching RBA decisions like they're the most important thing in your property journey. Instead, focus on these three numbers. Get your DTI below 5x. That's the real competitive zone. Anything below 5x and you're in good shape. Above 6x and you're fighting an uphill battle with new APRA rules. Lock in an LVR below 80%. That means saving a proper deposit, 20% if you can manage it. Yes, you can borrow with less, but every point above 80% LVR costs you thousands in LMI and higher interest rates. The deposit matters more than the rate. Keep your serviceability rate below 30% and ideally below 25% to have some breathing room. If your mortgage is taking 35% or more of your income, you're stretched. You're one financial setback away from stress. Get those three numbers right, and interest rates almost become secondary. You'll be able to service your loan even if rates tick up. You'll qualify at most lenders, not just one, and you'll have flexibility if the market shifts. So if you're buying in 2026, here's what I want you to do before you look at houses. Okay? Step 1, calculate your DTI right now. Out of all your existing debts, your car loans, credit cards, personal loans, HEX, help, everything, divide your annual gross income. If it's above 5x, commit to paying down some debt for 6 to 12 months before you buy. If it's above 6x, you need a solid plan to reduce it because new lenders will be more cautious. Step 2, get a pre-approval and understand the actual LVR. Don't just get a generic pre-approval letter. Ask the bank, what's the maximum loan you'll approve at an 80% LVR? That number is your real borrowing capacity without LMI. Everything above that requires LMI, higher rates and stricter serviceability tests. Step 3, stress test your serviceability. So calculate your total monthly debt servicing at current rates Now add 3% points to that interest rate and recalculate your repayments. Is that number still less than 30% of your income? If not, either increase your income or reduce your loan target. Step 4, get a pre-valuation. Before you can make an offer on a property, ask your bank for a valuation estimate. Banks can't give a formal valuation without a contract, but they can give you a preliminary estimate. Make sure the bank's estimate valuation is at or above your purchase price. If it's significantly below, you're going to end up with higher LVR than you expect. And step 5, factor in the full cost of ownership. Don't just think about mortgage repayments. Include property taxes, insurance, maintenance, body corporate fees if they're applicable, and potential vacancy if it's an investment property. Some of these reduce your overall serviceability ratio. Make sure your total housing costs are truly sustainable. Now, if you're buying as an investment, not an owner occupied, there's a fourth number that matters almost as much as these three. And I want to touch on it really quickly. It's called the rental yield, or more specifically, cash flow. A lot of Australian investors buy property expecting capital growth. They expect the property to go up in value. And that happens usually. But in the meantime, they're losing money every month because rent doesn't cover the mortgage, taxes, insurance, and maintenance. That's called negative gearing. 60% of Australian investment properties are negatively geared right now. 60%. But here's what's changing in 2026. With tighter DTI rules, lenders are much more interested in cash flow. They want to see positive gearing. They want to see that the property is paying for itself. Why? Because if your property is negatively geared and you lose your job, and you have a high DTI, suddenly you're in a vulnerable financial situation. The bank sees you as risk. So if you're buying an investment property, especially as an investor with high DTI, focus on properties with good rental yields. Aim for 4 to 5% gross yield or higher. That's your margin of safety. A property that barely cash flows is a liability. A property that covers itself and generates modest surplus, that's an asset. And it becomes even more important if interest rates do tick up later this year. So here's what happens when you actually get these three numbers right. You get approved faster. Banks don't need to refer you to a credit committee. You just get approved. You get better rates. Lower LVR means you're in the bank's sweet spot. They're happy to lend you at competitive rates. You have financial breathing room. Your serviceability ratio is healthy. If your income drops 5%, you're still fine. If a rate rise happens, it stings, but it doesn't break you. You can buy again. Good DTI and proven rental cash flow means you can leverage your portfolio and buy a second property sooner. And you sleep better. You're not stretched financially. You're not stressed about interest rates. You're in a sustainable position. And honestly, you end up in a better property or at a better price because you're not desperate. You're not rushing. You're in a position where you can wait for the right opportunity, make a strong offer, and negotiate from a position of strength. That's worth infinitely more than obsessing over whether the RBA raises or cuts rates next month. And one more thing, and this one is important. I want to acknowledge that interest rates do matter in some situations. If you're already approved and ready to buy, and rates come down 0.5%, that saves you real money every month. Over a 30-year mortgage, that's $150,000 or more, and that's significant. And if you're on a variable rate and rates rise, you will absolutely notice it. Your repayments go up. That's real pain. But here's the distinction. For the decision of whether you can buy, these three numbers matter infinitely more than rates. But for how much it costs to borrow, rates matter a lot. So the strategy is use these three numbers to determine how much you can borrow. Use interest rate forecasts to determine when to lock in a rate. But you've got the first part right before the second part even matters. So as we head deeper into 2026, with new lending rules in effect, the market uncertainty, and with conflicting rate forecasts, I want you to remember this. Everyone's talking about interest rates, but the banks are looking at three other numbers, and those three numbers will decide whether your property dreams are achievable or they're impossible. You've now got that knowledge. You know what they're looking at. You know how to calculate these numbers, and you know that fixing them is more valuable than waiting for rate cuts. That puts you ahead of 95% of property buyers out there who are still obsessing over the RBA decision. Use that as an advantage. If this video genuinely changed the way you think about property strategy, please like it and leave a comment below. Tell me which of these three numbers surprised you the most. because your insights help me understand what's actually useful to you guys, and that shapes the videos that I make next. And if you're serious about property investing in Australia, subscribe to the channel. Every week I break down the numbers that actually matter, not the headlines, but the metrics that directly impact your ability to build wealth through property. The algorithm doesn't help educational content like this spread, unfortunately. So your subscription and your like are genuinely the only thing that helps me reach more Australians who want to make smart property decisions. Thank you for watching.